Well, good afternoon. Happy Friday, October 6th. Mark Milam here with Highland Mortgage. Let's get right to this week's market update. For the past several Fridays, kind of started off talking about this series saying, well, that wasn't the week we were hoping for in the mortgage market. And we keep thinking sooner or later, we're going to have a reversal of fortunes and we're going to see at least a ceiling get hit here with mortgage interest rates and we're starting to come back down. Unfortunately, that was not the case yet again this week. In fact, this week representing one of the worst weeks in the mortgage market so far this year. What's really behind this is data from the labor sector. Now, the Fed has made no secret about this. Ever since we started fighting this inflation fight, the Fed has tied success in inflation to weakening the labor market. The Fed basically feels like they need to drive up joblessness. They need to rein in hourly earnings. They need to bring a little pain into the labor market in order to get inflation under control. But let's don't lose focus. The goal here is to get inflation down to the Fed's target rate of 2%. It's just that the Fed has inextricably tied labor and weakening labor to inflation. And so that's why all eyes have been on all of these reports that we get on a monthly basis, whether that's jobless claims, whether that's continuing claims, whether that's non-farm payrolls, hourly earnings. That's why there's so much focus on labor right now. Why is it? Is it because it's always been that way for the past 20 years that I've been in the mortgage industry? No, it's because our Federal Reserve has pretty much told us that's the key to putting inflation back in the bottle. Well, as we've said time and time and time again for the past 18 months, if you're trying to hurt labor, if you're trying to increase unemployment in the United States right now, good luck. You have a really difficult job. We have a labor participation rate less than 63%. That means 37% of able-bodied people who could be working are choosing not to work. Those people are not counted in the unemployment figure. If you did count those people in the unemployment figure, unemployment wouldn't be in the threes. It would be approaching 7%. But we're not counting those people. And so it's really hard to drive up joblessness when you have 37% of the people who could be working, they don't want to work. At last check, there's about 1.6 to 1.7 open jobs for every person that's looking for a job. So if you're trying to drive up joblessness, best of luck to you, but you're not going to have a whole lot of success there. And if we're tying the fight to inflation, on inflation, to driving up joblessness, boy, we've got a really difficult fight ahead of us. And this week was the absolute pinnacle example of what we're talking about. Let me flip the screen around here and I'll walk you through it. Here's the week, here are the past 5 business days. That is not a pretty sight. That is not what we want to see in mortgage-backed securities. And here comes the reason why. So if we go back here and take a look at the beginning of the week, the jobs opening report, we posted 9.6 million open jobs in the United States. We thought we would have about 8.8 million open jobs. We posted 9.6 million, way above expectations. The ADP employment report came in, giving everyone a little bit of hope, but if there's anything that we've learned from that ADP unemployment report, it never seems to mirror the actual labor report from Bureau of Labor Statistics, so we'll put an asterisk by that, and we'll come here to initial weekly jobless claims coming in under expectations, really low, down at 207,000 against an estimate of 210. It's not like 210 is a whole lot anyway, and we came in under expectations. And then what happened today? So today we were expecting non-farm payrolls, hoping to piggyback on that ADP employment report to show that the economy's cooling. We're not adding a ton of jobs. And here we come in with an estimate of 170,000 jobs created in the past 30 days. And the data tells us that we created 336,000 jobs, almost doubling the estimate. That is exactly what our Federal Reserve did not want to see. Unemployment ticked up 1/10 of a percentage point. The one silver lining here is that average hourly earnings ticked down about 1/10 of a percentage point. And this hot news on in labor, lower than expected weekly jobless claims, higher than expected non-farm payrolls, job openings at 9.6 million, all of this points to the same direction. Things are not going the way our Federal Reserve would like. And for that reason, the market reacts negatively. We see stocks sell off. We see the 10-year Treasury yield continue to rise. We see mortgage rates continue to rise. And most lenders now approaching 8% on the 30-year fixed. Why is all this happening? Because our Federal Reserve has inextricably tied inflation to labor. And is that really the right thing to do? Well, let's take a quick look at what's happening with inflation as of the last check. This is the United States Core Personal Consumption Expenditure Price Index, and you can see what's happening with inflation over time. What's it doing? It's going down. Is it going down a little bit or is it going down a lot? Well, it's going down a pretty healthy clip right here. As a matter of fact, inflation is in the threes when you strip out volatile food and energy prices. So we're starting to see inflation. Listen, a year ago, we had inflation that was roughly 9%. We're now down into threes. If anybody had fast forwarded and said, hey, by Q4 of 2023, you'll have inflation in the range of between 3 to 3.5 to 4%, do you think that would be good news for rates? Everyone would say absolutely yes, inflation is moderating. But the problem is our Federal Reserve doesn't say that. Our Federal Reserve says we have a problem with the labor market. We need to crush labor. We need to drive up unemployment. We need to drive up joblessness. We haven't done that. And so the market reacts very unfavorably. Let's take a look at some of these labor numbers, then I'll let you get to your holiday weekend. So when we start talking about job openings, right? This is job openings in the United States. We can see the Fed really wanted to see this number continue to come down. It spiked back up here in the past 30 days, up over 9.6 million open jobs in the United States. Just echoing the point that it's really tough to hurt labor. This is the non-farm payrolls number. This gets a little bit interesting because there's maybe some devil in the details here. 22% of the jobs that were created in the past 30 days were government jobs. So, that's really not a private sector issue. That's a government issue. If we take a look at what kind of jobs these were, all of these jobs were part-time. These are part-time positions that got added. If you go to full-time jobs, we actually subtracted jobs from the non-farm payrolls over the past 30 days. Full-time positions declined, part-time positions increased, and that explains, folks, the decrease in wages. So wages actually went down. Let me go back and show you on the screen. Wages actually went down by 0.2% month over month. It gets an estimate of 0.3. Why is that? Well, because we're talking about part-time workers here. And if we want to look at the change in real hourly earnings and real weekly earnings since January of 2021, look at how much earnings have actually declined on a month over month basis since January of 2021. So we're seeing earnings decline. Most of these jobs we're adding are part-time jobs anyway. Yes, we got 9.6 million jobs opening, but listen, we don't really care about job openings. What we care about is getting inflation down. And we just showed you the core PCE is moderating smartly. And with adding student loan debt back into the mix, pandemic savings is running out, credit card debt usage is at an all-time high. Surely we're going to see inflation continue to moderate as we move through the winter months. But that is not good enough for our Federal Reserve. And that's the problem that we have in the mortgage market. If I can be of any service to you over the holiday weekend, please don't hesitate to reach out. Mark.Milam at highlandmtg.com.